Stop looking at the distractions in the Red Sea and stop analyzing the smoke rising from the burning decks of the Marlin Luanda, because while those events are kinetic and visually arresting, they are merely the symptoms of a much deeper fracture in the global architecture. The real event that has just occurred within the last 48 hours is not a missile strike, but a price dislocation that signals the terminal phase of the current monetary system. You need to focus your attention entirely on a single number that has flashed across the trading terminals in the East. $112. That is the price of 1 ounce of silver on the Shanghai Gold Exchange, as recorded in the most recent dataset. While the Western markets in New York and London are trading paper contracts at a lower level, the physical reality in China has detached itself and launched into the stratosphere. The premium between Shanghai and London has now expanded to $15 per ounce. This is not a rounding error. This is not a market inefficiency. This is a structural failure of the arbitrage mechanism that has kept the global price of silver suppressed for 50 years. In a healthy market, when the price of an asset is $15 higher in one location than another, traders will immediately buy the asset in the cheap market and sell it in the expensive market to capture the risk-free profit. This action forces the prices back into alignment. That is the law of supply and demand. That is the law of gravity in financial markets. But today, that law has been repealed. The gap is not closing. It is widening. The fact that a $15 gap exists and persists proves that the silver in the West cannot move to the East fast enough to satisfy the hunger, or more terrifyingly, that the silver simply does not exist in the quantities required. You are witnessing the formation of a firewall, a partition of the world into two distinct spheres of economic reality. On one side, you have the Western paper market, where price is determined by high-frequency trading algorithms and naked short selling of contracts that have no backing in the physical world. On the other side, you have the Eastern physical market, where price is determined by the actual availability of the metal that is needed to build solar panels and electric vehicles and guidance systems for missiles. The Shanghai price of $112 is the truth. The London price is a lie. And the gap between them is the measure of your danger. This divergence is the siren alerting you that the vaults are empty and the run on the bank has already begun. But the price dislocation is only the surface-level evidence of a much more calculated strategy that has been deployed against your wealth. To understand why this premium is permanent and why it will likely expand until it breaks the COMEX entirely, you must look at the regulatory weapon that was activated on January 1st of 2026. The Ministry of Commerce in Beijing did not just wake up and decide to pay more for silver. They implemented a strategic export licensing system that fundamentally alters the flow of matter on this planet. By classifying silver as a strategic resource alongside other critical minerals like antimony and tungsten, China has effectively turned its national border into a one-way valve for precious metals. Silver can enter China to feed its industrial furnace, but it cannot leave. This is the death of the arbitrage trade. Even if a bullion bank in London wanted to ship physical bars to Shanghai to crush the premium and make a profit, they know that once that metal crosses the border, it is gone forever. It enters a black hole. It becomes part of the national strategic reserve of the dominant manufacturing power on Earth. This policy is a deliberate weaponization of the supply chain. China knows that the West relies on a fluid global market to mask the fact that it has printed trillions of unbacked currency units. By locking down the physical inventory of silver, China is forcing the true price discovery to happen on its own terms. They are draining the West of its remaining physical capital. Every ounce of silver that leaves the vaults of the London Bullion Market Association to chase that $15 premium in Shanghai is an ounce that will never return to settle a claim in New York. We are watching a liquidation of Western heritage in real time. The bullion banks are trapped in a nightmare scenario. If they do not ship metal, the premium rises and exposes the paper market as a fraud. If they do ship metal, they deplete their own vaults and accelerate the inevitable default. This is a siege. It is not fought with tanks or artillery, but with premiums and export licenses. The blockade is financial, but the consequences are physical. The inventory levels at the COMEX and the LBMA are bleeding out to satisfy this insatiable demand from the East, and when those inventories reach effective zero, the paper price will become meaningless. You will not be able to buy silver for the paper price any more than you can buy a unicorn. The only price that will matter is the price you pay to physically possess the metal. And right now, Shanghai is telling you that price is $112 and rising. But the export controls are just the mechanism of the trap. The bait that lured the world into this position is the industrial dependency that the West has foolishly ignored for decades. You must realize that this is not 1980, and this is not a speculative bubble driven by brothers trying to corner the market. This is a survival impulse driven by the fundamental laws of physics. The Chinese economy is positioning itself to dominate the energy transition and the digital revolution. Both of these futures are built on silver. You cannot have a solar panel without silver paste. You cannot have an advanced electronic circuit without silver contacts. The demand for silver in Shanghai is not speculative, it is existential. That is why the premium is sticky. That is why it will not collapse. The industrial buyers in Shenzhen and the strategic planners in Beijing are not looking at the daily chart. They are looking at the geological reality that mining supply is collapsing at the exact moment demand is exploding. We have seen reports from Chile in the last 24 hours that workers at the Escondida mine have severed the access roads. We have seen reports of water infrastructure sabotage at Mount Overde. The supply of copper and its byproduct silver is being choked off at the source in South America, while simultaneously being hoarded at the destination in Asia. The West is standing in the middle holding a paper contract and wondering why the shelves are bare. This is the definition of a supply shock. But unlike an oil shock, which can be mitigated by releasing strategic reserves, the West has no strategic reserve of silver. It was all sold off decades ago to suppress the price. There is no backup plan. There is no second vault. The only source of silver left is the existing above-ground stock, and that stock is migrating east at a record pace. The Shanghai premium is the vacuum cleaner that is sucking the room dry. This creates a feedback loop of panic. As Western industrial users realize that the metal is flowing to China, they will begin to panic buy. They will stop trusting the futures market and start demanding physical delivery. This is the run-on-the-bank moment for the metals market. When Apple and Tesla and Samsung decide that they need to secure physical inventory to keep their factories running, they will not care about the spot price. They will pay whatever it takes. They will pay the Shanghai price. And in that moment, the paper market in New York will cease to function as a price discovery mechanism. It will become a vestigial organ, a relic of a time when the dollar was king and derivatives were trusted. We are moving into a world of physical possession where the only law is if you don't hold it, you don't own it. The implications of this $112 price tag extend far beyond the metal itself. It is a signal that the currency regime is fracturing. For 50 years, the US dollar has been the denominator for all global commodities. If you wanted copper or oil or silver, you paid in dollars and the price was set in New York. The Shanghai premium is a declaration of independence from that system. It is proof that the dollar is losing its ability to command real resources. If silver costs $15 more in Shanghai than in New York, it means that the dollar is worth less in Shanghai than in New York. It means the fungibility of the global currency is breaking down. We are seeing the early stages of a hyperinflationary event that is localized in critical assets. The things you need will skyrocket in price, while the things you do not need will deflate. Silver is a thing you need. It is the most conductive metal in the universe. It is the antibiotic of the periodic table. It is the reflector of light. It is indispensable to modern civilization. And it is being repriced by the people who actually make things. The bankers in London who shuffle spreadsheets are losing control to the miners in Peru and the manufacturers in China. This is a shift in the balance of power that happens once a century. The silver wall that China has erected with its export licenses is designed to protect its internal economy from the coming devaluation of Western fiat currencies. They are locking in value. They are converting their trade surplus into hard assets before the music stops. The Shanghai premium is not a bubble. It is the lifeboat, and the lifeboat is leaving the dock. The passengers on the deck of the Titanic in New York are still arguing about the dinner menu, while the passengers in Shanghai are already rowing away. The fact that you can still buy silver in the West at a discount is not a blessing. It is a temporary glitch in the matrix. It is a window of opportunity that is closing rapidly. When the arbitrage opportunity is finally exhausted, because there is no more physical silver to ship, the price in the West will snap up to meet the East. It will be a violent adjustment. It will happen overnight. You will go to bed with silver at $30 and wake up with silver at $100 and no inventory available for sale. This is the nature of a currency collapse. It happens slowly and then all at once. The Shanghai premium is the slowly part. We are rapidly approaching the all-at-once part. Now, you must confront the brutal reality of your own position in this unfolding disaster. You have been warned. The data is public. The premium is visible on the charts for anyone with the courage to look. The regulatory filings from the Chinese Ministry of Commerce are a matter of public record. The bleeding of the COMEX vaults is documented in the daily warehouse reports. There is no conspiracy here. There is only math. And the math says that the current price of silver in the West is a mathematical impossibility that cannot be sustained. You are living in a distortion field, a temporary suspension of reality purchased with paper derivatives. But reality always wins in the end. The physics of supply and demand are undefeated. When the last bar of silver leaves the vault in New York to catch a flight to Shanghai, the game is over. The curtain will fall on the paper charade. The question you need to answer right now is not about geopolitics or macroeconomics. It is a simple question of personal inventory. You are witnessing the greatest transfer of wealth in history, and you are currently on the wrong side of the trade. You are holding currency that is being rejected by the physical market. You are trusting a pricing mechanism that has been falsified by the East. The silver wall is built. The gate is locking. The time for analysis is over. The time for action was yesterday, but today is all you have left. Do not let the complexity of the situation paralyze you. It is simple. Silver is leaving. Paper is staying. Choose which one you want to be holding when the music stops. Do not look away from this truth. Do not pretend that you can eat paper contracts or build a future on digital promises. The audit is mandatory. It is time to open your safe and look at what is actually there. Count the ounces. Feel the weight. If the number of physical ounces you hold is 0, then you are a statistic. You are a victim in waiting. You are standing on the tracks, watching the train approach and arguing about the schedule. Stop lying to yourself. If you do not hold the metal, you do not have a position. You have a delusion. Write the number down in the comments below. If it is 0, write 0. Admit that you are unprepared. Admit that you have ignored the warnings. The Shanghai price is $112. What is your price? What is the price you will pay when the shelves are empty? Prove that you are awake. Write the number down.